Oil is up, gold is down. Hello, I'm Joe Deaux reporting from Wall Street for your commodities update on November the 11th. West Texas Intermediate crude prices are gaining as positive Chinese economic data and industrial production and retail sales offset investors' worries of rising supply. I spoke earlier to Michael Smith. He's the president of T&K Futures and Options, and he said the good Chinese data suggests the world's largest consumer of oil won't soon slow its draws. Smith said that in the short term, he does think WTI prices will continue to consolidate and move sideways, and he added that he remains bearish on the commodity, and it could dip to as much as $85 a barrel in 3 months. Gold prices are slightly lower on Monday. I have a special guest with me who is in Iowa to talk about that. Jim Wyckoff of Kitco.com. Jim, thanks so much for being with us.
Hello, Joe. Nice to be with you.
So, Jim, we're looking at good Chinese economic data. Is that what's pushing the gold price a little bit slightly downward?
No, actually, Joe, we're seeing a stronger U.S. dollar index near a multi-month high. You're also seeing some lingering bearish effects of last Friday's stronger than expected U.S. jobs report that has thrown a scare into the marketplace that the Fed might act to cut back on its bond buying program sooner than the marketplace had anticipated late last week.
Yeah, sure. The classic scare because of the good news. Let's turn to silver for a moment. Silver moving in the opposite direction of gold, at least for today. Are we seeing those industrial characteristics really coming out in the price?
Well, Joe, you did that Chinese economic data that shows the world's second largest economy and a voracious commodity market, raw commodity consumer on the upswing is bullish for the metal sector. However, you're starting to see silver back off a little bit also based upon the weakness in the gold market and some technical selling. New 3-week low in the silver market on Monday morning.
All right, Jim Wyckoff of Kitco.com. As always, we appreciate it. Today, I have a special guest in studio with me. His name is Ronald. He's a New York Law School professor who spent more than 40 years covering commodities exchanges and regulations. Thanks so much for being here today.
Thank you for inviting me.
So Ron, the CFTC just comes out with some new rules trying to essentially protect investors in relation to the MF Global bankruptcy that we saw in the past couple of years. What should retail investors know about these new regulations?
Okay, so the goal of all regulatory, like the CFTC regulation, is to enhance customer protection, to protect the end users of the futures markets. And no one is a stronger advocate than I am of that goal. So before I joined the law school faculty some 6 years ago, I was a managing director in the global futures area at Lehman Brothers. I left before the bankruptcy.
Yeah.
But the more important thing from that perspective is in September of 2008, when Lehman filed for bankruptcy, not a penny was lost by any consumer, by any of our clients, and they traded all over the markets, all over the world. Lehman, even though they filed for bankruptcy, the systems and structures and the customer asset protections regime in place protected our customers. Then 2 years ago, as you just mentioned, MF Global filed for bankruptcy, and there was a shortfall of $1.6 billion. And I just read recently that the trustee for MF Global, it appears that most of their monies will finally be returned, but it took 2 years to get their money back.
Right.
About 10 days ago, the CFTC came up with adopted new rules on enhancing customer asset protections. And while the purpose and the principle of most of those regulations were great, one of the concerns is that they're going to require clients to maybe be forced to pre-fund their margin, and two, they may be required to put up greater or larger margin, meaning excess margin, with their brokerage firm.
Sure.
And that's a big concern to a lot of the end users.
Right, so why is this a big concern? I mean, we've already seen some trade organizations come out and say that they're not so hot on this. Why?
Okay, so a year ago, the CFTC dropped a great rule requiring all margins to be posted at the clearinghouse that's required for each product. It's called the gross margin rule. Great rule. Haven't done a study yet to see whether or not how important or effective that gross margin rule is. Now, because of this new rule, there's a possibility that farmers and other retail clients not only have to pre-fund. Normally it's done on a T+1 basis, but it could be T+3. And then two, the FCMs may require the retail clients to post greater margin, leaving excess money at the FCM, which is what happened in MF Global. MF Global, that $1.6 billion shortfall was a result of excess margins being held at MF Global and not posted at the clearinghouse. So we don't know yet. It's a wait and see type of approach, but there is a great concern addressed, as you mentioned, by a number of the agricultural trade associations.
Sure, and already a little bit of uncertainty, but we will always see that. Thanks so much, Ron.
My pleasure. Thanks for inviting me.
That's what's happening on Wall Street today with commodities. For The Street, I'm Joe Deaux.